Hello and welcome to Ipswich's Real Estate Podcast, a podcast where we help you navigate the often complex world of buying, selling and renting homes here in Ipswich and the surrounding areas. I'm Steve Athanates, I'm the owner of NG Real Estate here in Ipswich. I'm joined today by a great friend of the show, Steve Beach from Stanford Financial. Hello, Stephen.
Hey, Steve.
Mates, haven't seen you for a while. I missed the last episode in terms of our rate prediction, but here we are today for the announcement of the Reserve Bank's decision. So without any further ado, what happened?
So I guess more good news. So they did go on pause again, or hold. So
Perfect. That's what I predicted, Stephen.
We were just talking about this just before the show. I don't know if I actually did a prediction.
I definitely did.
Last podcast with Danny, who was filling in for you. I think it was a little bit disjointed. We didn't have the normal to and fro.
Yeah, but rubbish backwards and forwards.
I think I was advised that I did say at some stage throughout the podcast that I did say that they're probably going to be on pause. So hopefully I did say that. So that means I finally got one right, because I have been wrong the last 3 meetings. I guess moving forward, I guess some of the key data that we normally talk about is, I guess, inflation rates in itself. So we did see, I guess, inflation go from 4.6 down to 4.2. So that's headline inflation. Trimmed or median inflation did remain pretty much the same. So a few different bureaus were saying it was 3.3 to 3.4. Some went 3.4 to 3.5. Some said it stayed the same. Depending on what data they're pulling out, or why they call it the trim mean, is essentially they pull out some of the discounts.
And that's one of the key indicators the Reserve Bank's looking for is that
trimmed inflation. So being that sort of remain, I guess, the same is why they, part of the reasons why they put rates on hold. But the second one is unemployment went from 4.3 to 4.5. Now, this data sort of did get released a couple of weeks ago. So I guess a lot of predictions and a lot of banks saw this information come through, and they've sort of been throwing their 2 cents in. Even as early as last week, we're starting to see some of the major banks actually cut fixed rates. So we're seeing some rate cuts come through.
That's a good indicator. Might be worthwhile just stopping there for a second. When we start to see banks drop fixed rates, okay, that's normally an indicator that they see some, I guess, movement in the markets.
Yep. So that's a lot to do with what we call as the swap rates, that essentially they're securing funds, predicted over the next period of time, and that's where you see 1, 2, 3, 4, and 5 year fixed rates. So we're seeing 1 and 2 year fixed rates sort of start to come down, 3, 4, even bigger discounts on that. So like you just said, we're anticipating that the rates are going to come down. So it means some banks are securing money overseas or internally via term deposits. So some people are actually saving money, and then when that gets secured in the bank, it means the banks can actually lend that at a cheaper rate than comparative to others.
All right, so perfect. So the good news is, whilst there's no actual relief, no one was predicting a cut for this period. However, there's no more pain, okay, or no added pain. There's no rate rise, so rates are on pause.
Yep.
When's the next meeting?
So I think it's early in August. I think it's the 6th or the 7th of August from memory. So they always meet on that Tuesday.
So that one's about 6 weeks away?
They're always 6 weeks. They're pretty much 6 weeks every there used to be ultimately 11 per year. It was the first Tuesday of every month, excluding January. They never met because the December inflation was already. Now it's literally every 6 weeks. So that's why they sort of do 8 meetings, is because they're doing 1.5 months between. Part of the reason why they also changed that structure is because they now get that inflation data monthly as well. It used to be more of a quarterly analysis, and then they would sort of predict whether they should move rates based on every month, based on the quarterly data. So being that they're getting it monthly now, something that they keep talking about is, because we're getting the information like quite regularly, we're going to see spikes and troughs sort of thing. So with that, we see unemployment go up, then it goes down, and then it goes up. But over a quarter, we would see it fairly stationary. So that's why they're saying that, like, not every month, I guess it's a good indicator going, hey, unemployment went up. Probably shouldn't have swore. Then
That's okay.
Unemployment goes down.
We're all adults. We're all adults here.
So, so when we see those sort of spikes, we don't need to jump on board going, we need to quickly lift rates, or we need to quickly, cut rates. So they're sort of saying, hey, make sure that we're sort of looking at everything as an annual figure or a quarterly figure, not just solely on that monthly data.
Okay, well, perfect. That makes sense. Now, I guess some news that's come to light in recent days. Obviously, one of the key things that really put so much pressure on inflation was this war in Iran. Obviously, fuel shortages, which has basically now made everything skyrocket,
Yep.
transport, food, everything. Now, obviously, the war in Iran is over, maybe.
The peace treaty,
Yeah, so we've got a peace treaty. I think it was signed.
Signed yesterday. Yeah.
So the 15th of June, the peace treaty's been signed. Here we are today on the 16th with the Reserve Bank meeting. Now, obviously, there's some things that the federal government's been doing. They've obviously been subsidising the fuel tax and obviously giving us some relief at the Bowser. As of the 1st of July, I think fuel automatically pops up another 32 cents back to normal price. Yep. That'll be exciting for everyone. And obviously, I think the government's now, they're taking a let's wait and see type attitude to what's going to happen in the future. I think they're not suggesting any more cost of living relief.
And that came a lot from the Global Monetary Fund saying, governments, don't go out there and throw away money because that's only going to continue pushing inflation. So fuel price going up pushes up inflation. And they did talk about, and we spoke a little bit about this on the last podcast, is there's almost two waves of inflation based on what's happened with oil prices. So we saw it immediately in our back pockets via putting fuel in our cars. The next sort of wave of inflation is the passing on of transport costs by businesses. So with Woolies having to truck food everywhere and the distribution centres, taxis, these sort of things. So that's the next wave of inflation that we're probably going to start to see come through. So with two of the highest inflation numbers every month for the last few months has been housing and transport. So they're the two major indicators. I think the government kind of kicked us in the teeth a little bit with the budget in regards to capital gains tax and negative gearing and I guess the real uncertainty around what's actually going to be legislated, because part of that budget, although it's been signed off by the lower house, hasn't been signed off by the Senate, so it hasn't been legislated yet. So that's been an interesting conversation and I've thrown my toys out of my cot a few times with some of the banks around what should be accepted and what shouldn't be accepted.
Yeah, look, it definitely has created uncertainty. There's no two ways about that. So, in a perfect world, we wish it would all go away and we'd just go back to normal. But probably unlikely that's going to occur. But for everyone, a little bit of uncertainty there. It has definitely impacted house prices. Has the government stopped spending? Because that's been one of the drivers too of inflation, is the government just keeps spending money. That hasn't slowed down either?
No. Government, the monetary policy hasn't tightened in that sort of capacity from the public sector. They're talking about that they're finding policy cuts and they're tightening the reins on the budget through a lot of their policies, but I'm not really seeing any sort of really tightening of screws in regards to a lot of their external expenditure.
Right, okay. Well, I guess it's come to that time. It's prediction time. We've already discussed the Reserve Bank will meet again in 6 weeks' time.
Yep.
I personally don't see a lot of change. Hopefully, we do see some easing of the pressure in terms of, obviously, if the Strait of Hormuz opens up again and we get more fuel and we get all these things flowing again, hopefully some of these transport costs will come down. Invariably, the biggest problem we've seen, even after COVID, prices are quick to shoot up. Just like interest rates, real slow to come back down to normal. So it'll just depend on if people start to pass on some of these savings, because there should be real savings. So on that basis, my prediction is I think rates will remain on hold again during the next meeting. What are you thinking?
I'm saying the same. They're going to stay on hold. I think we haven't seen the full impact of the 3 rate rises that we've already had. Again, if the conflict was still ongoing, there would almost be grounds for them to maybe even potentially raise rates today. But being that it is, I guess, subsiding and the treaty's now signed, I think we will see sort of some normality over the next few months.
Well, it's funny. I sort of say this to people. I think we would have got over the war in Iran. The federal budget is the thing that's really just kicked everyone in the backside, and it's had a profound effect on confidence, and that confidence translated across all sectors of the marketplace. So whether you're in real estate or share markets or Bitcoin or whatever you're into, cryptocurrency and all this sort of stuff, it's all taken a bit of a smashing.
Oh yeah.
So yeah, I think uncertainty is a killer in our economy, and people either get paralysed and do absolutely nothing, or even worse, we get a bit of fear mongering and people starting to really talk things down. The one thing I would say from a real estate perspective is houses are still transacting, people are still buying, people are still selling, the world hasn't stopped spinning, and our advice to consumers as a whole is don't panic. Okay, we've seen this before. It is an artificial stimulant, I guess, of what the government's done. They have deliberately just basically put the brakes on everything. So once this all settles down, I think it'll be back to business as usual.
And that's something I think everybody wants to have, is that clarity and that reassurance that this is the norm. And that's the factor that's unknown at the moment, is that it's not legislated. Like I literally just, before I came into the meeting today, I was on the phone to one of the major banks who's like, Stephen, I'm really sorry. I know we spoke yesterday. The bank's just released a new lending policy regarding negative gearing, and in the event of, unfortunately, if people get separated and then one party buys out the other person's house, then that portion of the money that they're borrowing against now can't be negatively geared. It's treated as a purchase after the 13th of May. So there's so much, I guess, uncertainty, even from the bank's perspective. They're going, well, we kind of interpret it this way and we kind of read it this way. And that's what I was saying before, how I've been sort of fighting a lot with sort of banks in regards to borrowing capacity and how they interpret negative gearing versus neutrally gearing, or they call it now limited gearing. I've spoken to a few brokers and they're like, oh, Steve, it's reduced borrowing capacity by 300,000 to 400,000. No, it hasn't. I've run the scenario multiple times, and the borrowing capacity's actually only dropped by about $60,000 to $70,000 sub $1 million investment property purchase. So it's not as crazy as what everybody anticipated, purely for the fact that what we saw was, rental incomes, might be $40,000. You used to claim $55,000 worth of expenses over a property. You can still claim on tax up to that $40,000 mark. It's just that extra $15,000 that gets carried forward. So what everyone was saying is there's no negative gearing. So everyone was saying there was no gearing at all. So you couldn't claim anything on an investment property. Well, that's not true. You can only just claim up to your income that you're making on it. So it's not as, I guess, daunting as what everybody first anticipated, as, this is going to, cut out the legs from investors or anything along those lines. To give you an idea, I think I have 167 pre-approved applicants at the moment to buy investment properties. Like, probably about 100 of them didn't even affect their borrowing pre-approvals. There was only a few of them that we went, hey, listen, we went a maximum purchase amount. We do need to bring that back by about $60,000 to $70,000. So it wasn't a huge shake-up of the market. So it's just something that, I guess, to keep in mind as well, particularly for everybody who's out there looking at either selling or purchasing, particularly in Southeast Queensland, sort of our target market. You would probably notice it. I haven't really seen anybody come back to me going, hey, great news, Steve. That property that I was looking at's dropped by 50,000. It's hey, great news, Steve. There's only 8 people looking at it rather than 38 people. So, I can offer, a realistic price and get it not at a 10% above market price. I'm now getting it 2-3% above market price.
Which is exactly what we said. This change in circumstance always represents an opportunity for someone. And I think buyers are probably getting a bit of a better shake of the stick at the moment, because, as you're saying, there's not as many people looking, there's not as much competition, and therefore the prices aren't as high. So this market represents a great opportunity for buyers. Now, guys, a lot of great information there from Steve in relation to what's happening with negative gearing, what's happening in terms of the actual, I guess, the psyche of the Reserve Bank and what they're thinking. Guys, as usual, you hear all of the best stuff here on Ipswich's Real Estate Podcast. If you'd like to know more, you'd like to see more, if you've got any questions, click the link below. We'd love to hear from you. Your feedback's very important to us. As always, a huge thank you to Steve Beach from Stanford Financial. Anyone looking to buy an investment property, refinance, all those sorts of things. Steve looks after me personally, so cannot recommend Steve and his team at Stanford Financial highly enough. So thank you, mate, for joining us again.
Absolute pleasure.
We'll see you again in 6 weeks' time for another prediction on what's going to happen. I'm sure we're going to be proved right again.
Yes.
All right, so we'll see where we go. But that's all we've got for now. So once again, I'm Steve Athanates. I'm from NG Real Estate Ipswich. We look forward to seeing you on the next episode of Ipswich's Real Estate Podcast.